Recent changes broadened the number of corporations and the types of executives that Section 162M of the Internal Revenue Code covers. Keep watching to learn what it means for executive compensation, corporate taxes, and more. Publicly held corporations. The Tax Cuts and Jobs Act changed the definition of a publicly held corporation. Section 162M now includes any corporation that, as of the last day of its tax year, either is an issuer of any class of securities required to be registered under Section 12 of the Securities Exchange Act, or is required to file reports under Section 15D of the Exchange Act. This new definition includes domestic corporations with publicly traded debt. It now includes some foreign corporations. Publicly held subsidiary corporations are also included. Covered executives. Before the changes to Section 162M of the Internal Revenue Code, the compensation deduction limit in each fiscal year applied to 4 executives at a corporation. The limits affected the person serving as CEO of the corporation on the last day of the fiscal year. The 3 highest paid executives who weren't the CEO or the CFO were also covered. The Tax Cuts and Jobs Act broadened this definition in several ways. Section 162M now applies to anyone who served as the CEO during any part of the fiscal year. The CFO is no longer exempt. Any executive who served as CFO during any part of the fiscal year is also a covered executive. Section 162M continues to apply to the next 3 highest paid executives after the CEO and CFO. The types of executive officers found in the Securities Exchange Act are the only ones who can qualify as classified under Section 162M. In addition, executives classified as covered in 1 year keep that classification. The executive remains a covered employee of the corporation even after the employment relationship ends or the person dies. Deduction limit. The deduction limit continues to be $1 million per covered executive. However, corporations can't exclude performance-based or commission-based compensation anymore. Compensation includes the total remuneration given to an executive for services performed in any capacity, including as a director or consultant. Many corporations will lose some tax deductions under the new Section 162M rules. However, they may benefit from increased flexibility regarding executive compensation. Under the old IRC Section 162M rules, the process to qualify performance-based compensation for a tax deduction was lengthy and expensive. Corporations no longer have to follow those procedures. They can change their compensation practices to lower administrative expenses. They can give their boards more flexibility. Executive performance goals are no longer limited to quantifiable measures like business productivity. Companies can now use subjective performance measures like increasing social responsibility. Some investors fear that companies will become less transparent in how they compensate their executives. The major trading exchanges still require companies to have independent compensation committees, though. Shareholder approval of equity compensation plans also remains a requirement. Elimination of the Ipo Transition. The Tax Cuts and Jobs Act eliminated a transition period that used to be available for companies that became publicly held. Under the old rules, compensation that a company paid to executives and disclosed to prospective shareholders before the company became public was exempt from the deduction limit. The transition period generally lasted 3 years. Companies are now subject to the Section 162M deduction limits for the taxable year when they become public. The limits apply to compensation paid before the initial public offering, but during the same taxable year. The new rules apply to corporations that become publicly held after December 19, 2019. The rules apply no matter how the company becomes public: initial public offering, spin-off, etc. To simplify your tax season, visit our website, thepaystubs.com, and we'll help you take the stress out of your tax preparation. And if you enjoyed this video, be sure to like, comment, and subscribe.